Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. So, big downgrade on US debt markets, only the second time ever. All this is happening as the US government's net interest rate cost keeps climbing up to multi-decade highs, but despite rates moving higher, despite the downgrade on US Treasuries, US companies are not feeling the pain. Labor market's still very resilient. Let's talk about why they haven't felt the pain of higher rates just yet. So obviously this week, US bonds were downgraded from AAA down to AA plus, right? That's the second best rating that you can possibly get. This is actually only the second time this has ever happened in history. The first time was actually by the S&P back on August of 2011. They downgraded the US, similar to what Fitch is doing today, from AAA down to AA plus. Interestingly, it's been sitting there at that level for more than the past decade. Fitch is just catching up to that right now. If you remember back then, this was following a similar scenario where Obama signed a bill to avoid a government default, similar around that issue with government and governance around the US government and debt ceiling. That downgrade has never been reversed yet. If you look back historically, the S&P 500 lost nearly 18%, actually had a drawdown down to the October lows, ultimately went back to about break even by the end of the year. Much of that decline in the S&P 500 happened before the decline, or the downgrade rather. One other interesting note, yields were actually near 52-week lows when the downgrade happened and eventually went even lower back in 2011. This time, near 52-week highs and a significant uptrend, and we've seen rates kind of push higher significantly during the past couple of weeks. Now, what's this mean for the government? I think rates obviously going to continue to go higher in the short term. Net interest cost and weighted cost of marketable debt. So you look at the weighted cost of interest right around just south of 3%. But if you look at that net interest cost, right, that's the amount of interest that the government is having to pay as a percentage of tax revenues, up clearly almost at 7%. That's its highest level in almost 25 years. Okay, so the government, what they're bringing in versus what they're paying, that ratio is not looking very strong relative to the past 20, 25 years. What could that mean? We could see continued pressure on, number one, the government cannot wait for the Fed to start cutting rates. Number two, the government, when they look at their balance sheet, obviously looking to bring that net cost tax revenues ratio down. One way, limited spending. We're all talking about potential spending cuts due to the debt ceiling increase budget for next year. There may be continued pressure on Congress around that in the coming years. Now, companies aren't feeling the pain yet. We haven't seen significant layoffs across industries. Couple reasons why. One of them, S&P 500, excluding financial companies, monthly estimated return on cash, right? What cash they have on hand, what kind of interest are they earning? Well, they're earning a lot. $6.6 billion in the most recent month. That's the highest level in nearly 30 years. So they're earning a lot of interest on that cash. Makes sense, right? Fed funds rate at its highest level in decades. But interestingly enough, interest expense, right? They're going to have to pay higher rates going out too. Not the case. Look at this. This is the difference between the interest expense that companies in the S&P 500, excluding financial companies, are paying minus that interest that I just showed on the other chart that they're earning. It's actually not high at all. It's the lowest level in multiple years. Why is that? Most US companies put out issued debt when interest rates were very low, longer maturity. So right now they're still paying on that longer dated, low fixed interest rate, and they're earning cash on that short end of the curve. Very favorable now. At some point when they need to refinance or finance new projects at these higher rates, that's when we're going to see pressure put on these companies. But right now, that's not the case. Finally, in Wisconsin, a scary situation for some amusement park enthusiasts. We had roller coaster riders trapped upside down for hours due to mechanical issue in Wisconsin. I would not want to be them. Fortunately, within several hours, they were able to get out there. Firefighters and other officials helped them down. So scary situation. Would not want to do that. Does not sound like a lot of fun this weekend. With that, I want to thank everyone for watching, and I will see you next time.